15.3%. If you're self-employed, you know exactly what this number is. It's not just some random figure. It's the hidden tax that bites into your profit from the very first dollar you make. It's relentless, and honestly, it's one of the biggest financial headaches for anyone in the gig economy. But what if I told you that number isn't set in stone? I mean, really. What if there were legal strategic moves you could make to fundamentally change your financial reality and legally slash that number? Sounds good, right? Okay, let's dive in and see how it's done. So in this explainer, we're not just going to give you a few quick tips. Nah, we're going bigger. We are talking about building a full-on financial fortress. Think of it like we're looking at the architectural blueprints for a rock-solid tax strategy, designed from the ground up for freelancers and business owners just like you. So here's the game plan. We'll start by tackling the core problem, then we'll lay down the foundation, build up some fortifications, get into the inner workings, and then we'll unleash the ultimate weapon. Let's get to it. First things first, you gotta know your enemy, right? For anyone who's a freelancer or gig worker, the biggest opponent out there is what's called the self-employment tax trap. Seriously, it's this huge financial anchor that just gets heavier and heavier the more money you make. So, what is this thing, really? Well, it's that 15.3% tax on all your net earnings, and it covers your contributions to Social Security and Medicare. Now, here's the kicker. When you're a regular W-2 employee, your boss pays half of that. But when you're self-employed, nope, you're on the hook for both halves. And let me tell you, that can be a real shock to the system. Now that we've stared the beast in the eye, it's time to build our first wall of defense. And this is probably the single most important decision you're going to make. Why? Because picking the right business structure is your frontline defense against that big 15.3% tax. So a lot of people, and maybe this is you, start out with a standard LLC, and that's fine. But by default, the IRS just kind of looks right through it. They call it a disregarded entity. That means you're taxed just like a sole proprietor, and yep, all of your profit gets hit with that 15.3% tax. But, and this is a big but, choosing to be taxed as an S-Corp? Oh man, that completely changes the game. Okay, let's break down exactly how this magic works. Let's say you make $100,000 in profit. With a default LLC, that entire 100 grand gets hit with the tax. Boom, that's $15,300 right out the door. Now watch this. With an S-Corp, you split your income. You pay yourself a reasonable salary, say $30,000. That part gets taxed, but the other $70,000, you take that as a distribution, and guess what? It is not subject to self-employment tax. Your tax bill plummets to just $4,590. That one move, that one single move, just saved you more than 10 grand. Incredible, right? So the big question is, when should you do this? When do you pull the trigger? Well, expert analysis suggests there's a magic number. Once your net income starts consistently hitting that $50,000 to $60,000 mark, that's the time. At that point, the money you save on taxes is almost always going to be more than the extra paperwork and costs involved. So our foundation is solid. Now it's time to build up the walls, the fortifications. This is all about getting smart with your big business deductions. And you'll see there's often a choice to make. Do you want the easy route, or do you want the most profitable route? And a perfect example of this is the home office deduction, a classic, right? You've got two paths, the simplified method or the actual expense method. So which one is going to build a stronger wall for your fortress? Okay, this simplified method is, well, it's simple. $5 a square foot, capped at $1,500 total. You barely have to keep any records, super easy. But then there's the actual method. Yeah, this one takes more work. You've got to track a percentage of your rent, your utilities, your insurance, all that stuff. But the payoff, it can be huge. We're talking a deduction that's often 2, 3, even 5 times bigger. It's a classic case of more effort equals a much bigger reward. And you know what? We see this exact same pattern play out with your car. When it comes to the vehicle deduction, again, you've got a choice. Go with the simple standard mileage rate, or do you knuckle down and track all your actual expenses? So, standard mileage is predictable. All you need is a mileage log. Pretty straightforward. The actual expense method, on the other hand, means saving every receipt for gas, insurance, repairs, you name it. It's a pain, no doubt. But for a lot of business owners, especially if you have higher vehicle costs, this method can give you a way bigger deduction. It just hammers home that key principle, right? The easy way is rarely the most profitable way. So the walls are up. Now we're going inside the fortress to engineer the complex stuff, the inner workings. We're talking about more advanced systems now. This isn't just about saving on taxes today. This is about protecting your assets and growing your wealth for the long haul. And there are two key systems we need to look at here. First, we've got retirement accounts, and I mean powerful ones, like a solo 401k that slash your taxable income right now. And second, we need a strategy to separate your assets, to build a firewall between your personal wealth and any risks your business might face. And this leads us to a really high-level concept some experts call the T formation. Picture a capital T. The top bar represents the separation. On one side, you have your S-Corp, your active business. It's making money, but it's also where the risk is. On the other side, that's where you put your valuable assets, your real estate, your investments, safely tucked away in their own separate LLCs. What this does is amazing. If someone sues your business, they can't touch your personal assets. They're protected. And that vertical line of the T, that's a trust forming the base of it all, making sure your legacy is protected. Our fortress is built. It's strong, it's secure, but every fortress needs an ultimate weapon. And what we're about to talk about, this is it. This is a super powerful strategy that can dramatically alter a high-income earner's tax liability. It's known as the short-term rental loophole, and the mechanism behind it is pure genius. See, normally, if you have a rental property and it loses money, those losses are considered passive. You can only use them to cancel out other passive income. But this loophole, it lets you reclassify those losses as active. And why is that a big deal? Because active losses can be used to wipe out the taxes on your main income, your W-2 job, or your business profits. It's a huge difference. So how do you pull it off? Here's the 5-step battle plan. Step 1, you get a short-term rental property. Think something where guests stay less than 7 days on average. Step 2, you have to materially participate. That means you're actively managing it for at least 100 hours a year. Step 3, and this is key, you get something called a cost segregation study done. This lets you accelerate depreciation and create a massive paper loss. And then the final step, you take that huge paper loss and use it to torpedo the tax bill on your main income. Done. And the impact here is it's profound. I mean, according to expert analysis, just one of these strategies, when done right, can cut a high earner's tax bill by 50 to even 100%. Think about that, 100%. It's an absolute game changer. So there you have it. We've gone through the entire blueprint, from laying the foundation to deploying the most advanced weapon in the arsenal. But remember, a fortress like this is built one piece at a time. So the real question for you is, which cornerstone are you going to lay first?